Welcome to Alan Berry Reports TV. I'm your host, Alan Berry Labucan, from alanberryreports.com. Well, this is one of our big shows for the year. Every year we do our Outlook show and reports. In those, we give our overview and outlook for the year ahead on various different assets. Why it's one of our favorite shows to do every year has a lot to do with the challenge. I've heard people in the say before that, well, nobody can really tell what's going to happen into the future. And my argument with that is some people are fairly good at it. We've had a very good record over the years, at the top of our peer group. As far as making these kind of forecasts, and the reason that that has a lot to do with it is the focusing on the fundamentals, trying to keep emotions out of it, and then looking at trading patterns to try and determine what's going on. We do a lot of homework on this report for this report, and we really like to do this report, and we've had a lot of success in our annual Outlook reports in the past, and so we're going to try and do it again this year. And actually, for the last few years, every year we kind of make it a little bit more difficult. In 2009, we had an exceptionally good group of calls that we hit right on the money. 2010, we added more assets that we made our predictions on, had another great year. Last year was challenging for everybody. We had some really great picks, some that weren't so great. All in all, it was a good year, everything considered. And the main reason that we do these things is when you've got to try and look forward for a year ahead, you really have to pay attention to the big picture. And one of our key arguments for investors that we think help investors to outperform the market has a lot to do with being able to stay focused on the fundamentals. That way, when the stock market or there's a lot of volatility and there's a lot of emotion in the market, you're able to see through that emotion by staying focused on the big picture. And that's why we do this exercise, and that's the main reason that we do this exercise. So, on that note, we're going to get started with this year's Outlook 2012 is this year's show. And we're going to start with some of the stock markets. Each year we do that, kind of break it into a few different things. We're going to start with the stock markets. The first, what we'll do is, as we're talking about each asset, we'll start by going over some of the reasons that we follow them. Then we'll talk about the numbers, and then we'll give you some logic behind why we came up with those numbers. So the first one we're going to start out with today is the Dow Jones Industrial Average. The reason that we follow the Dow Jones Industrial Average is it is the most followed stock index in the world. And it has a lot to do with how investors, it's sort of a great barometer for the sentiment of investors. If the Dow is performing well, investors tend to have a good sentiment. And when it's not, and that is the opposite, they have a poorer sentiment. And it plays itself out for stocks across the board, whether they're large stocks or small stocks. Investors, if their sentiment is bullish, stocks are going to perform well, big or small. And so that's why some of the key reasons we follow the Dow Jones Industrial Average. So now the numbers that we're looking for, and this is the key thing that we're going to be changing this year, is how we talk about the numbers. And this is going to add a lot to the challenge this year. We've never done this in the past. We're going to start with where we think the low for the year is, the high for the year, and where it will close the end of the year. This gives us a better chance to, why we're doing it this way is it gives us a better chance to grade our performance at the end of the year. So we're going to start. Our low is 12,000 points on the low. The high is 14,500. The close is, we're looking for a year-end close of 2012 of 14,000 points on the Dow Jones Industrial Average. The other big exchange that is very highly followed and is also a barometer for the sentiment of investors is the S&P 500. And it has many of the same dynamics as the Dow Jones Industrial Average, but it's a broader index of 500 companies. And so what we're looking for there on the low is 1,270 points. On the high, 1,500 points. On the yearly close of 2012, 14,050 points. The logic behind that bullish sentiment or bullish outlook for the Dow and the S&P 500 has to do with current valuations. We think that those valuations are at the low end of the historical norms, and this is creating great bargains out there. We think that the American domestic economy is going to be improving throughout the year, which will help grow the earnings. And as the year goes on and the earnings improve and people start seeing the economy improve and employment improve, we think that that's going to help sentiment throughout the year. And that's why we're looking for the closing prices to be very close to the high prices that the highs that we're looking for. And so we think that in sentiment is going to improve throughout the year and drive valuations up to more realistic values. So the next indexes that we follow are the Toronto Stock Exchange and the Toronto Stock Exchange Venture Market. The reason we follow the Toronto Stock Exchange is and the Toronto Stock Exchange Venture Market is that those two indexes are very much aligned with what is happening with commodity prices. In case of the Toronto Stock Exchange, often the key leading segments of that index are big cap oil and big cap mining stocks. And we're going to talk a little bit more about some commodities later, but we do have a bullish outlook for oil, gold, and other commodities. And so we think that that's going to be the key driving engine of the bullish trend for the Toronto Stock Exchange. On the Toronto Stock Exchange, we're looking for a low of 12,000 points. We're looking for a high of 15,000 points, and we're looking for a close of 14,000 points. This also is a great indicator of the Toronto Stock Exchange of what's happening with the global economy, and because it's so tightly tied to commodities. We think that the global economy is going to be much like the American economy, improving through the year. The second half, I think, is going to be really much better for the global economy, and that's again why we're looking for the close to be very close to the yearly high, and we're expecting throughout the year to see it reach those highs and close very strong for the year. Now, the Toronto Stock Exchange Venture Index has a lot more we'll go through the numbers, then the logic. The low we're looking for is 1,500 points. The high is 2,500 points. And the close is 2,200 points. The real lead in the Toronto Stock Exchange Venture is the price of gold. There's a lot of smaller, high-growth kind of exploration junior gold companies in the Toronto Stock Exchange venture market, and it does have a big impact. The gold movement has a big influence on what happens with the Toronto Stock Exchange venture market. And so we like what's going to happen with gold. We think that it will also be helped out by stronger commodity prices. Again, this is hanging on our belief that we think there's going to be an improving global economy. It's kind of been it's been slowing in the last 6 months or so. We think it'll start to grow again, and stronger growth and stronger demand for commodities, and that's why we see the Toronto Stock Exchange and the Toronto Stock Exchange venture market perform in a bullish trend. All right, so before we get into the commodities, usually we do the commodities next, and then we do some other assets. We're going to do the other assets first and then commodities. So bonds. This call we've been wrong on for so long. I'm not sure anybody should even pay attention to this. We've felt for a long time that several years now that there's been an abundant supply of government debt and suspect demand when the largest buyer of government debt is the Federal Reserve. This is why we call it suspect demand. We have felt in the past that we're much more comfortable with corporate debt. The stronger economy, the better fundamentals, the fact that there's not an abundance of that kind of debt and probably pretty healthy supply, we would think that the bonds, the corporate debt would perform better than the government debt. But again, we'd caution people that we've been wrong on our bearishness towards the bond market for a long time. The Federal Reserve hasn't helped us out in that regard by manipulating the market, but nonetheless, we've been wrong. And so approach that one with a word of caution. On the interest rates, we see that there's zero chance of the Fed raising interest rates this year. We think they'll stay exactly where they are. On the currencies, because we have a bullish outlook for the global economy, and that will put added pressure on commodities that have relatively weak supply chains. We think that this is going to make countries that are dependent on resources, commodities, as their, the key driver, such as Canada, Australia, other countries that commodities, the production of commodities has a big influence on what happens with their domestic economies. We think that those will outperform the U.S. dollar. Our basic negativity to bearishness towards the U.S. dollar is much like the government debt. There's abundant supply, suspect demand. This doesn't make us comfortable and can't get bullish on the U.S. dollar. We think that the economies are going to improve, so we don't think that, the U.S. dollar is going to be under massive pressure, but we're looking for the resource currencies to outperform. The one that we'll use as our barometer is the Canadian dollar. It's currently trading a couple pennies under par. We think that it'll get above par throughout the year, not dramatically, say somewhere around 1.05, maybe even as much as 1.10. But nonetheless, we think that resource currencies will outperform the U.S. dollar, and again, we'll use the barometer of the Canadian dollar as our key barometer as to how this call performs when we do our next year's annual end-of-year wrap-up review. And so now we're going to move into our commodities, and we're going to start with gold. On the gold, why we follow gold so much is, it's another good way to have exposure to the improving economies of China, or to the high growth economies of China, India, and other emerging economies. In these countries, the people love to adorn themselves, wear gold, and hold gold as a store of value. And as those economies continue to grow, they're growing the middle class. And as the middle class is growing, they've been having a big influence on the bullish trend of gold for the past decade, and we think that that will continue. Now, also to add to our bullishness towards gold, gold is much like many other commodities. For many years, there was for a couple decades, there was a severe underinvestment in exploration to find new discoveries that could turn into future producers. And this is why there is weakness in the supply chain of gold. And with this strong demand, we think it's an ideal way to get exposure to the economies, the growing economies of China, India, and other emerging economies without having to go and pick stocks. As the economies grow, more people can afford gold, and that's going to push the price up. And so that's our rationale, or why we follow gold. The numbers that we're going to give on the low, we're looking at, and by the way, on all of these prices for the commodities, we're going to be talking in US dollars. So don't want to repeat that each time. So the low we're looking for is right where it started the year. $1,598 is around the start of the year price. We think that the low has already been set. We think the year is going to be very bullish, with a high of $2,100 per ounce and a closing price right around $1,950 per ounce on gold. Again, the logic behind that is much with what I opened. That there's strong demand. That as the global economy gets stronger, there's a lot of people in that global economy that like to wear and hold gold as a store of value, and then you've got weakened supply chains, and that is consistent with this year. We're as bullish now as we've ever been on the price of gold. We think that it's been going on for a decade long, based on solid fundamentals of supply and demand, and then we're going to have another great year for the price of gold. And so we're very bullish on gold. Now, when it comes to silver, many of the same arguments of what I just talked about with the price of gold are consistent. It tends to outperform on the upside and outperform on the downside, and but generally follow the same kind of a trend. And so we're looking for a bullish trend for the price of silver, with the low, again, right around where it's starting the year, $28.50 per ounce. We're looking for a high of $42 per ounce and a year-end close around $40 an ounce. And again, the logic behind this is much like the logic behind gold. There are some more industrial usages for silver, and so as the global economy picks up, it will help the price of silver out as well. So we're looking for a very bullish trend for the price of silver. The next commodity is copper, and why we follow Dr. Copper is it is a very good indicator of what's going on with the global economy. And that's why it's called Dr. Copper. They say it has a PhD in economics. It is a very good predictor of what's going on with the global economy. And that's when we talk about where we see the global economy, copper is one of the key indicators that we look at to give us insight into where the global economy is going. So on the copper price, we're looking for a low of $3.40 per pound. We're looking for a high of $4.20 per pound. We're looking for a close around $4 per pound. Again, the key indicators that we see that will drive the price of copper. Again, copper also, like gold and silver, went through a couple decades of underinvesting to find new discoveries. The supply chains are the supply chain of copper is relatively weak. This is bullish, but the key driver will be an improving global economy that will put pressure on that supply chain and help the price of copper out this year. And so then the next one is oil. We're coming to the conclusion that we'd like to call it Dr. Oil as well. Dr. Oil is much like Dr. Copper. What's happening with the global economy, you can tell a lot about what's happening with the global economy based on what's happening with oil. We think it also has a PhD, so we follow that very closely. On the price, we're looking for a low of $95 per barrel. On the high, we're looking for 100. Oh, and by the way, when we're talking about the oil price, we're talking about the West Texas Intermediate price. That is, we're not talking about Brent oil. There is a gap between Brent oil and WTI. WTI is the most followed one, so that's why we're going to use those prices. But the same fundamentals of what drives WTI also drives Brent. So we'll use the WTI numbers. So on the low, $95. On the high, $115. And we're looking for a year-end close at that high of $115. The logic is much like copper, strong, not relatively weak supply, not enough past exploration to find new discoveries, has weakened the supply chain. As emerging economies grow rapidly, they demand a lot of oil, just like copper, for that growth. And as we see an improving global economy, we think that that's what's going to drive the price of oil to a very handsome returns this year. The final commodity that we follow is uranium. We think that uranium is one of the most important sources of energy in the world. It's critical to countries like China to power up that economic growth, and it is also a commodity that has gone through many years of exploration. There's been a long-term gap between supply and demand. That gap has been filled by decommissioning nuclear weapons in Russia. That source is getting weaker and weaker. They're running out of that source, and when that source is gone, there will still be much stronger supply or demand than there is supply, and that's why we think it will drive the price higher. We're looking for a year-end close of, the low of right around where it is right now, which is $52 per pound of U3O8. We're looking for a high of $80 and a close around $80. So we think that we're going to see a nice, healthy trend, bullish trend that gains strength throughout the year, and we see a close right around where we see the high. That's all the key commodities that we are all the key assets that we do our annual call. We like to add to the challenge. So this year we did the high, lows, and closing prices. Before we close, we wanted to mention a couple things. In the past, we basically did our Outlook show, and then we did a year-in review show. This year, we're going to add some quarterly reports in there where we review how these calls are going. So, look forward to those at the end of each quarter. Also, if you want to keep up on all the work that we're doing, whether it's our online shows, our reports, our paid reports, our private reports, whether we're on, if we're going to be on, sometimes we get, throughout the year, we get called to be on television. We send out updates when that happens, any public speaking engagements. It's a really great way to keep up on all the work that we do at allenberryreports.com, and there's no charge to be on it. So if you'd like to stay in the loop, subscribe to our email. There's a couple spots on the website. Just look to my, if you're watching this show on the website, just look to the top left of the website, and you'll see a subscribe button in there. And there's also one in the bottom left as well. If you want to watch any of our past shows, look above me. There's a show section, and that's where you can find all of our past TV guide, and all of our past shows are in there with links to go watch them and overview of what we talked about. Also look above me we have what's called a report section. In there, it's kind of like somewhat of a blog. From time to time, we put comments in there, and that's another way to keep up on what we're working on. And so we invite you to check that out on a regular basis as well. We've got a couple of couple other things that you can be aware of when it comes to our website. We did a lot of work in the last quarter of 2011 on our website. We added a couple things. We've got a shop section there if you're interested in our private reports. We also have a work with us, public companies. We offer to select public companies an opportunity to have banners on our website, which helps them showcase what they're working on and get in front of our audience. And we also offer some digital marketing consulting, and you can find all of that out on our work with us. And then our contact us page is another one we'd encourage you to check out. We love hearing from our subscribers and those viewers and readers, and feel free to send us any comments or advice or things you think we're missing or companies you think we should follow. And we don't always get back to everybody on the emails. We get a lot of them, but we try to read them all and do the homework on what is being recommended. And then finally, the other thing I wanted to mention again was our shopping section. That's a new thing that we started in mid-December. Basically what it is we're doing private reports only to people who subscribe. Well, you can subscribe for an annual price, or you can also buy each individual report and go to our shop section, and that's where you'll find all the details on our private reports. So on that note, we'd like to wrap things up, and we always stress that this show and our reports are for information purposes only. We aren't making buying or selling recommendations. It's important for you to do your own homework and speak with your financial advisors before making any investment decisions. We're always trying to grow our audience, and any efforts you make to get the word out is greatly appreciated. We also like to send some thank you messages to those that are important in us being able to do our shows. We use youtube.com as our primary website to produce and broadcast these shows. For anybody who wants to produce shows, we highly recommend them. For people that want to watch videos, we love videos. That's why we do them. And it's a great website for that sort of stuff, and we highly recommend them. Also, if you're watching the show on our website and you look to my left, over there we have our banner sponsors. Those banner sponsors are really important in us being able to do the work that we do. And if you want to do some homework on those companies, click on their banners. It's directly linked to their websites, where they have plenty of information for you to do your research on those companies. So check out our banner sponsors. And of course, to you, the viewers, if you didn't show up, we wouldn't have a reason to do the shows. And we really value highly the opportunity that you give us to have a platform to talk about our reports. So Thank you very much for tuning in. On that note, we hope the new year is getting off to a great start for everybody, and we hope you also hope that you tune in for future shows. Have a great day and a happy 2012. We'll talk to you soon.